On January 21st, 2026, more than $1 trillion vanished from the US stock market in a single trading session. The S&P 500 lost over $1.2 trillion in value. The Dow dropped 870 points. The Nasdaq plunged 2.4%. This wasn't a COVID panic. This wasn't a banking crisis. This was something stranger. A president threatening tariffs over an island nobody expected him to actually want.
I may put a tariff on countries if they don't go along with Greenland, because we need Greenland for national security.
And the market's response revealed something uncomfortable about how fragile confidence really is. Here's what happened, why it happened so fast, and what it exposed about the machinery beneath the world's largest economy. January 21st started like any other Tuesday. Markets opened normally. No earnings disasters, no geopolitical shocks overnight. Then selling began. Not slow profit-taking, aggressive liquidation. By midday, the S&P 500 had erased every gain it made since January 1st. The index went negative for the year in 6 hours. The trigger wasn't hidden. President Trump had spent the weekend threatening 7 European Union countries and the United Kingdom with new tariffs unless they supported his push for American control of Greenland. Not trade disputes, not currency manipulation. Greenland, a Danish territory with 57,000 people and strategic Arctic access. On Monday night, boarding Air Force One, Trump escalated. French President Emmanuel Macron declined an invitation to join Trump's proposed Board of Peace. Trump's response to reporters was immediate. I'll put a 200% tariff on his wines and champagnes and he'll join, but he doesn't have to join. That statement hit trading algorithms before markets opened Tuesday. What happened next wasn't just stock selling. Investors dumped U.S. government bonds simultaneously. Treasury yields spiked, which translates directly into higher mortgage rates and personal loan costs for Americans. Citigroup analyst Scott Cronert summarized the mood in a client note. We are only 2 weeks into the new year, and the number and magnitude of impacts on U.S. equity markets is already dizzying. The fear wasn't about Greenland specifically, it was about predictability. If the president could threaten major trade partners over territorial ambitions unrelated to commerce, what else becomes negotiable? Investors started hedging. Money flowed out of U.S. stocks and bonds into metals and international equities. The message was clear. America might not be as reliable a trade partner as previously assumed. By closing bell, over $1.2 trillion had evaporated from the S&P 500 alone. The index fell 2.1%. Its worst single-day performance since October. But this was just the most recent example of a pattern that's been accelerating. Rewind to April 2025. That's when the real devastation occurred, April 2nd, 2025. Trump called it Liberation Day. He announced sweeping tariffs affecting nearly every sector of the U.S. economy. The response was immediate panic selling across global markets. The next day, April 3rd, the Nasdaq Composite lost 1,600 points, the worst sell-off since COVID lockdowns began. The S&P 500 dropped 4.84%. The Dow fell 1,679 points. Then, China retaliated. April 4th, China imposed a 34% tariff on American goods. The Dow collapsed 2,231 points, down 5.5%. The S&P lost nearly 6%. The Nasdaq dropped 5.8%, entering bear market territory. Within 2 days, the Dow lost over 4,000 points. The S&P fell 10%. The Nasdaq shed 11%. Total value destroyed? Over $6.6 trillion. The largest 2-day loss in market history. Japan's Nikkei 225 fell 7%, triggering trading halts. Oil prices collapsed over 7% to 2021 levels. The VIX, Wall Street's fear gauge, spiked to 45.31 points, the highest close since the 2020 crash. Then something unexpected happened. Trump announced a tariff pause. The market reversed violently. The Dow surged 7.87%, the biggest gain since March 2020. The Nasdaq jumped 12.16%, its largest one-day gain since January 2001 and second best day ever. Trillions of dollars in value restored in hours. This whiplash revealed something critical. The The market wasn't reacting to economic fundamentals anymore. It was reacting to policy volatility itself. Here's the uncomfortable part. The tariffs didn't just create market chaos. They're actively reshaping the economy in ways most people don't see yet. Goldman Sachs research shows companies and consumers collectively paid 82% of tariff costs by October 2025. By July 2026, Goldman estimates consumers alone will bear 67% of the burden. Trump claimed tariffs would bring manufacturing back to America. The Institute for Supply Management reports U.S. manufacturing activity has contracted for 10 consecutive months. Trump said tariffs would create jobs. The Bureau of Labor Statistics shows the economy added only 584,000 jobs last year. Apart from the pandemic year of 2020, that's the weakest jobs market since the Great Recession. Meanwhile, tariff rates jumped from roughly 2% at the start of 2025 to 12% today. The average tax on U.S. imports reached its highest level since 1935. The Supreme Court is now reviewing how much authority the president actually has to impose tariffs under existing law. If the tariffs are struck down, J.P. Morgan estimates more than $135 billion in collected revenue could become eligible for refunds. But the mechanism for companies to pursue those refunds remains unclear, and replacement tariffs could quickly fill any fiscal gap. That's the machinery. Policy creates volatility. Volatility destroys value. Value destruction forces economic contraction. But there's another layer beneath this that explains why the losses happen so fast. The market isn't made of rational humans anymore. It's made of algorithms responding to headlines in milliseconds. When Trump's comments about French wine tariffs hit newswires Monday night, trading bots didn't pause to assess geopolitical nuance. They detected threat escalation and executed sell programs. By Tuesday morning, institutional investors were responding to price movements those algorithms had already created. Humans were reacting to machines reacting to words. That's why $1.2 trillion disappeared in 6 hours over Greenland. And that architecture explains what happened on January 21st, 2026, in a way most analysis missed. Greenland wasn't the crisis. The words about Greenland were. Here's what actually triggered the sell-off. Trump threatened tariffs on 7 European Union countries plus the United Kingdom unless they supported his acquisition bid for Greenland. Then, Monday night, boarding Air Force One, he escalated. French President Emmanuel Macron declined to join what Trump called a board of peace focused on Gaza. Trump's response to reporters, "I'll put a 200% tariff on his wines and champagnes and he'll join, but he doesn't have to join." Trading algorithms processed those sentences before human analysts finished reading them. Threat detected, escalation confirmed, execute sell programs. By Tuesday morning, institutional investors weren't responding to policy analysis. They were responding to price movements algorithms had already created overnight. The S&P 500 fell 2.1%. The Nasdaq dropped 2.4%. The Dow shed 870 points. Over $1.2 trillion erased in 6 hours. But notice what happened Wednesday. Trump announced he'd reached a framework for a Greenland deal and wouldn't impose the threatened European tariffs after all. The S&P rallied 1.2%, recovering more than half the previous day's losses. Hundreds of billions in value restored in hours. The pattern reveals the mechanism. Policy uncertainty creates algorithmic volatility. Algorithmic volatility generates human panic. Human panic produces real economic consequences. Then the cycle reverses just as violently when uncertainty resolves. Citigroup's Scott Cronert captured the exhaustion in a client note. "We are only 2 weeks into the new year, and the number and magnitude of impacts on U.S. equity markets is already dizzying. 2 weeks into 2026, already dizzying. But there's a deeper structural problem emerging beneath these headline-driven swings. The market isn't just overreacting to news anymore. It's fundamentally overvalued heading into a period of maximum uncertainty." The S&P 500's cyclically adjusted price-to-earnings ratio hit 39.4 in December 2025. That valuation has only appeared in 25 months since the index was created in 1957. The last time it reached these levels? The dot-com bubble. When the CAPE ratio exceeds 39, historical data shows the S&P declines an average of 4% over the next year and 20% over the next 2 years. The Buffett indicator, Warren Buffett's preferred market valuation metric, sits at 221%. It last approached 200% right before the S&P entered a bear market. The Shiller price-to-earnings ratio stands above 40.5, the second highest level in market history. These aren't predictions, they're measurements of current conditions compared to historical patterns. Natixis Investment Managers surveyed 515 institutional investors controlling nearly $30 trillion. 79% of North American institutions expect a market correction in 2026. 49% see a 10 to 20% decline as likely. 20% expect something steeper. 63% cite valuations as their primary concern. S&P 500 put option prices, which incorporate risk premiums and expected returns, indicate an 8% chance the market drops at least 30% during 2026. So you've got record valuations, meeting maximum policy volatility, meeting algorithmic trading systems designed to amplify both. The ingredients are present. The question is timing and trigger. The market includes safety mechanisms designed to prevent total collapse. Circuit breakers halt trading when the S&P 500 falls 7%, 13%, or 20% in a single day. After the 1987 crash, the Brady Commission recommended these systems to allow communication between traders during severe declines. But circuit breakers create their own problems. As the market approaches the threshold, the probability of triggering increases, which intensifies selling pressure. Traders know a halt is coming, so they rush to exit positions before getting locked in. This magnet effect actually accelerates declines near circuit breaker levels. During the halt, investors hold positions without ability to rebalance, which reduces willingness to hold stocks when trading resumes. The price must fall further to attract new buyers. The last time circuit breakers triggered was March 2020 during COVID lockdowns, 4 times in 10 days, March 9th, 12th, 16th, and 18th. The mechanisms worked as designed, providing pause during unprecedented uncertainty. But they didn't prevent the crash. They just gave it structure, which brings us to the only question that matters. What happens next? The honest answer is nobody knows. Not institutional investors controlling trillions, not algorithmic systems processing millions of data points per second, not policymakers whose words move markets before they finish speaking. But we know the conditions. Valuations at levels historically followed by significant corrections. Policy volatility generating trillion-dollar swings over individual comments. Trading systems amplifying every fluctuation in milliseconds. An economic foundation showing contraction in manufacturing, weakness in job creation, and consumers bearing increasing tariff costs. The Magnificent Seven tech stocks alone lost $1.4 trillion in value, recently entering correction territory. Tesla's market cap shrank nearly 40% from its peak. Nvidia lost $593 billion in a single day after DeepSeek's AI model emerged, the biggest one-day loss on record for any company. These aren't isolated incidents anymore, they're recurring patterns in a system operating near structural limits. So maybe the real lesson isn't about predicting the next crash. It's about recognizing we're living inside a machine that turns words into trillion-dollar consequences in hours, where safety mechanisms create their own instabilities, and where the gap between overvalued and corrected can close faster than human decision-making can respond. The market will do what markets do: allocate capital, discover prices, create and destroy value. But right now, it's doing all of that at a speed and scale that makes every policy statement, every algorithm trigger, every valuation metric a potential catalyst for the kind of day that erases trillions before lunch. Greenland cost $1.2 trillion in 6 hours. The real question is what the next headline costs and whether anyone sees it coming before the algorithms do. January 21st, 2026 wasn't the warning, it was confirmation. The machinery works exactly as designed. Words become volatility. Volatility becomes trillion-dollar losses. Losses become economic reality. And it all happens faster than humans can process, let alone prevent. The next headline is already written. Someone just hasn't said it yet.